This is the 12th lecture in the course, State of the United States Economy and Society. Throughout most of history, commerce has depended on the use of credit, particularly when large quantities of goods are involved. Kings, feudal lords, and governments have borrowed to engage in wars of territorial conquest or to defend territories already held. The stability of our economy today is dependent on the continuous access to affordable credit by business, government, and individuals. The question is, are we approaching death by debt strangulation? A few comments on the role money, credit, and debt have played in human history might be useful. The Crusades turned the Mediterranean into a vast trading area dependent on the use of gold and silver coinage and credit, bringing about the end of feudalism and its self-contained economies. As peasant farmers were charged money rents and taxes instead of a large portion of crops harvested, land also became a commodity to be bought, sold, and mortgaged. Debt became a constant feature of expanding commercial and civic relationships. For centuries, the banking families of the Mediterranean states provided the credit to fuel economic expansion and wars over territory and natural resources. The next great leap forward in the world's global economic structure was the establishment of the Bank of Amsterdam as a deposit bank, its, quote, receipt money circulating throughout Europe and beyond. The bank held the coinage of its depositors as full reserves for the paper receipts issued. For a time, this model of full reserve deposit banking stimulated a remarkable expansion of commerce between merchants in different countries. Today's global economy functions mainly on the use of digital monetary transfers. Central bank notes are issued independent of any reserves of gold or silver coins or bullion. The paper currency we hold or the balances we own in banks have a constantly changing purchasing power. They are, in a sense, promises to pay nothing in particular. By declaring this central bank notes and their digital equivalent as legal tender, government is able to raise needed revenue via taxation, fees for the private use of public lands, and other fees in exchange for competition limiting licenses. Only a small portion of our population possesses sufficient financial assets to do without credit to make major purchases, although the use of credit cards in lieu of cash is a common practice even for those who pay off the balance each month. More than half of credit card holders do so. Whether for business-to-business exchanges or business-to-consumer commerce, risk must be properly assessed and priced, or things do go quite wrong. Credit card debt is thought to be the number one reason individuals cannot put money aside as savings. Total outstanding revolving debt, which is chiefly made up of credit card balances, reached $1.07 trillion in May 2019. Total household debt hit $13.86 trillion in the second quarter of 2019. This total is $1.2 trillion higher than the previous peak in the third quarter of 2008. Fortune magazine reported in June that the National Association of Business Economics survey of over 50 professional economic forecasters see the economy growing, but at a slower rate in 2019 and 2020. They also believe a recession is very possible by the time the next president is to be inaugurated. A study of consumer credit card debt released in December 2018 by Elite Personal Finance, based on data from the U.S. Census Bureau, the Federal Reserve, and other sources, found that the median household credit card debt is $2,300, although the average debt is much higher at $5,700. During 2018, banks received $104 billion in interest and fees from their credit card holders. However, Bloomberg reported in May that credit card losses at the biggest banks are outpacing auto and home loans. The four largest banks in the United States collectively recorded nearly $4 billion in charge-offs from credit cards just in the first quarter of 2019. A growing concern is the aggregate credit card balances carried month to month, which were $420 billion in late 2018. The average U.S. household with credit card debt carries nearly $7,000 in revolving balances, subject to high rates of interest that make difficult paying off what is owed. As of the end of the second quarter of 2019, payments on about 5.2% of credit card balances were 90 days overdue. Only 1 in 6 of the 21% of Americans who say they have been delinquent on a credit card debt say that the reason for the delinquency is that they overspent on non-essential items. The most common reason people cited for being delinquent, 35%, they forgot. A full third said they had to pay for essential items, and 32% said they had to pay for an unexpected emergency. For most U.S. households, the highest level of debt incurred is mortgage debt, taken on as a result of the purchase of a residential property. Only a small portion of households have savings sufficient to pay cash for a residential property. Those who do have sufficient cash or other financial assets tend to be longer-term property owners who have benefited by loan amortization and by appreciation of the value of land under a home. The amount of equity may be sufficient upon sale to permit a cash purchase of another property, particularly for empty nesters downsizing in anticipation of retirement. The Federal Reserve Bank of New York reported in May that mortgage debt on 1 to 4 unit properties was $9.2 trillion at the end of the first quarter of 2019. As property prices continue to increase, property buyers are incurring increasing levels of mortgage debt. The economics are straightforward. Historically low mortgage interest rates enabled buyers to qualify for higher levels of borrowing, and this was capitalized by market forces into higher asking prices for property. More stringent creditworthiness standards required to qualify for a mortgage loan, combined with the gradual increase in wages for many workers, has contributed to a low rate of delinquencies. As of May, late payments were at just 3.36%, the lowest level recorded in data that goes back to 2000. The number of foreclosures started in May was 39,000, the lowest number in more than 18 years. CoreLogic's September 2018 economic outlook isolated the delinquency rates in Texas following Hurricane Harvey. Their analysis showed that the average FEMA disaster assistance grant was only $4,000, while average damage claims amounted to $110,000. Their analysis also considered the damage caused by the 5,000 plus wildfires that have burned across California. In an effort to mitigate the potential for widespread foreclosures, Fannie Mae, Freddie Mac, and FHA each came forward with disaster relief programs. Property owners, even if they are able to obtain the funds to rebuild, face declining property values because of the risk of future weather-related disasters. They are among some 5.4 million owners experiencing negative equity. Data analyzed by Zillow indicates that about 37% of U.S. households own their primary residence free and clear of mortgage debt. Roughly 1 in 4 property owners who are still paying down on a mortgage loan have at least a 50% equity position in the property. This graph, prepared by Bloomberg, shows that cost of living is a strong reason why owners are or are not able to repay their mortgage debt. An analysis of the residential property market by the National Association of Realtors indicates that buyers aged 36 and under have constituted more than 1/3 of all purchases for at least the last 4 years. 2/3 of these transactions have been to first-time homebuyers. Nearly 1/2 of these households are also servicing a median student loan balance of $25,000. Another major part of the nation's credit markets involves multifamily properties. Strong market conditions fueled a 6% increase in multifamily lending in 2017, generating $285 billion in new mortgages for apartment buildings with 5 or more units. While the number of loans originated remains relatively steady, the chart shows the loan amounts are rising as the total loan volume continues to rise. Rising construction costs are one reason for the high levels of borrowing. Average costs rose 5.7% in 2018, attributed to labor, materials, and taxes. Realtor.com also reported in April that most of the new construction is occurring in the South and Southwest, where land and construction labor is cheaper and there are fewer costly and time-consuming building regulations. Of all buildings started in 2018, 94% are for apartment rentals. The value of commercial real estate is generally determined by capitalizing the current and immediate future income stream generated by the use of the property. Based on this, a lender must determine what level of financing is warranted. A commonly applied 90% debt service coverage ratio requirement means that the property itself must generate income sufficient to cover 90% of any mortgage loan debt. The remaining 10% might then come from other sources of revenue. The Federal Reserve Bank of St. Louis reported in November of 2018 that the volume of commercial and industrial loans on the books of the nation's banks had grown to $2.25 trillion. Loan activity accelerated in December once companies had a clearer understanding of how the changes in taxation would affect their cash positions. Moody's Investor Service has recently expressed concern that a number of banks have loosened underwriting standards on commercial and industrial loans for their financially strongest customers. Explaining the history of the nation's credit markets over the previous 5 decades, Wolf Richter wrote in Business Insider in mid-2017 that a key indicator of the health of the economy, the volume of commercial and industrial loans, was not expanding, and this might be signaling a downturn on the horizon. Over the past 5 decades, each time commercial and industrial loan balances at U.S. banks shrank or stalled as companies cut back or as banks tightened their lending standards in reaction to the economy they found themselves in, a recession was either already in progress or would start soon. There has been no exception since the 1960s. We are an automobile-dependent nation, and that will not change anytime soon. About 1 in 4 people pay for a new automobile with cash, 3 out of 4 financing the purchase. U.S. auto sales totaled 17.274 million vehicles in 2018, with trucks and SUVs once again accounting for 2/3 of the market. The number of new vehicles sold fell by 2% from 2017, with strong competition from dealers specializing in the sale of quality pre-owned vehicles. Current projection of new car and truck sales for 2019 is 16.4 million units. As of the end of the first quarter of 2019, Americans owed $1.16 trillion in outstanding automobile loan debt. Banks and other lenders are expressing concern that the average amount financed is rising about 3.1% a year in dollar amounts. Moreover, the average new car loan originated by a finance company is nearly $30,000, an increase of more than $5,000 from 10 years earlier. Serious auto loan delinquencies, 90 days or more past due, jumped to 4.69% of outstanding auto loans and leases in the first quarter of 2019. This put the delinquency rate at the highest level since the fourth quarter of 2011 and almost 58 basis points below the peak during the fourth quarter of 2010. The number of loans made to persons with credit scores below 620 increased by 150% over the last 6 years. There were 1.8 million repossessions during 2017. As of June 2019, there were already 2.4 million repossessions. Some 6.7 million loans were reported as over 90 days delinquent. For borrowers who had no choice but to obtain financing from a subprime lender, the loan balance is not forgiven upon repossession of the vehicle. Lenders frequently file a lawsuit to garnish payments from the person's wages. There is yet one additional part of the credit market that involves automobiles. A study released in May of 2016 by the Consumer Financial Protection Bureau reported that individuals who put their cars up as collateral for short-term emergency loans are being charged with interest rates as high as 300%. 1 out of every 5 of these loans results in the borrower's automobile being repossessed. Around 20 million people are attending colleges and universities in the United States. Some 12.5 million students are under age 25, and 7.5 million are 25 years old and over. Total student loan debt is now over $1.56 trillion, owed by some 44.7 million persons with an average debt of $29,800, owed by those students who graduated in 2018. Student loans have seen almost a 157% increase in cumulative growth over the last 11 years. The Consumer Financial Protection Board found in 2017 that Americans aged 60 and older owed an average of $23,500 in student loan debt, double the average a decade earlier, though most of those loans were used to pay for children's and grandchildren's educations. The number of people aged 60 and over with outstanding student loan debt quadrupled from 2005 to 2015, increasing from about 700,000 to 2.8 million. This group increased during this period from 2.7% to 6.4% of the total number of student loan borrowers. A Federal Reserve Bank study released in 2015 indicated that borrowers over the age of 60 have the highest rate of delinquency. Nearly 40% of federal student loan borrowers over age 65 were in default. A CBS News story on the issue reported that 40,000 people over age 65 are having the Social Security benefits, tax refunds, or other government payments garnished because of unpaid student debt. Student loan debt currently has the highest 90-plus day delinquency rate of all household debt. More than 1 in 10 borrowers is at least 90 days delinquent, according to Bloomberg Global data. Student loan delinquency rates are close to their all-time 2012 high. For-profit colleges market to older adults and other non-traditional students who take on huge student loan debt but often do not end up with a degree or an income sufficient to pay off the loans. A recent Brookings Institution study states that enrollment in for-profit colleges increased sevenfold from 1990 through 2010, accounting for 10% of total enrollment. 20 to 25% of total borrowing, and around half of all loan defaults. This chart, compiled by U.S. News and World Report, shows that the annual tuition to an in-state public college for the 2017-2018 academic year averaged over $10,000. The tuition cost to attend a private college is nearly $43,000. An additional $10,000 to $11,500 is spent on housing and meals. And as has been widely reported, many students do not have enough money left over for food. A study by the nonprofit Complete College America, released at the end of 2014, reported that only 1 in 5 full-time students earns a bachelor's degree in 4 years. Nationwide, only 50 of more than 580 public 4-year institutions graduate a majority of students on time. At community colleges, the percentage who earn an associate degree within 2 years is just 5%. Among those who enter college, 1.7 million students begin taking remedial courses. Of this group, only 1 in 10 students ever graduates. There are corollary cost contributors that drive up the cost of a college education. Students take unnecessary, non-degree related classes because students want a break from the academic rigor of their majors. Also, fully 60% of students transfer from one college to another and lose credits toward graduation. Students frequently need a class that is either full or otherwise unavailable. That may leave them short of credit hours sufficient for scholarship and grant requirements. Therefore, students take classes they do not need simply to generate a credit hour load for financial aid purposes. A lending tree study of users aged 65 to 70 across the United States found that the average median non-mortgage debt is $20,643. What kind of debt? It's mostly auto loans, 37.9%, and credit card balances, 35.9%, with $1 in $8 owed on student loans. Personal loans accounted for about the same level of debt. For many seniors in our society, their one important potential source of income is the equity they have in a residential property. Rising property values translate into an estimated $6.3 trillion in equity homeowners 62 and older could utilize to obtain additional income under the federal government's Home Equity Conversion Mortgage, or HECM program. Analysis in 2016 of the viability of the HECM program by the U.S. Department of Housing and Urban Development indicated the costs of administration made the program economically unviable as structured. Changes were announced taking effect in October of 2017 to lower the amount that could be borrowed to 58% of homeowners' equity. This and other program changes reduced the attractiveness of the HECM program, resulting in a lower number of applications during the program's 2017-2018 fiscal year that began in October and ended September 30th. The volume for fiscal year 2018-2019 fell even further to 26,500. The annual report to Congress released in November 2018 by the Federal Housing Administration highlighted several problems with the program, including inflated property appraisals and ineligible occupancy by non-borrowers. As of September 2017, nearly 90,000 reverse mortgage loans were at least 12 months behind in payment of taxes and insurance, and were expected to end in involuntary termination. Worst of all, losses absorbed by FHA have absorbed about a third of the taxpayer-guaranteed insurance reserves. The Mortgage Bankers Association, the National Association of Realtors, and other groups support a review to look at removing the HECM program from the FHA Mutual Mortgage Insurance Fund. At an October 2017 congressional hearing, Housing and Urban Development Secretary Ben Carson agreed that separating the two mortgage programs would be a worthy pursuit. As of today, the issue is still only under discussion. Our national government has only four sources of revenue with which to pay for public goods and services. First is taxation. Second is charging fees for services and for private exploitation of natural resources on public lands. Third is for the U.S. Treasury to pay for goods and services with non-interest-bearing notes that circulate as legal tender. And fourth is to issue government securities, that is, to borrow from domestic and foreign investors. Local and state governments have all of the same options as does the national government, except that states are prohibited from issuing paper currency. Local communities, however, can issue their own currency, and a growing number are doing so because of the shortage of national currency circulating within the community. The longer-term ramifications of continuously funding public expenditure by the issuance of bonds is of great concern to some, of almost no concern to others. In January, the new chairman of the Federal Reserve Board of Governors, Jerome Powell, expressed his concern at the Economic Club of Washington, D.C. From the Fed's standpoint, we're really looking at a business cycle length. That is our frame of reference. The long-run fiscal non-sustainability of the U.S. federal government isn't really something that plays into the medium term that is relevant for our policy decisions. However, it's a long-run issue that we definitely need to face and ultimately will have no choice but to face. The national debt has now surpassed the $22 trillion mark and continues to climb. Economists engage in endless debate over the debt's threat to the U.S. economy. Debt as a share of GDP rose steeply during and after the 2008 financial crisis. Since 2013, it has equaled or exceeded GDP. At the end of 2018, debt had risen to 104.1% of gross domestic product. Since the early 1980s, the federal government has borrowed and spent, somehow expecting that a lowering of marginal tax rates on high-income individuals, on business profits, and on gains from the sale of financial and other assets would generate enough revenue to balance the federal budget and eventually pay down at least some of the national debt. This has not been the case. There is no plan to stabilize, let alone gradually pay down the debt. A real concern almost no one is talking about is whether the federal government will be able to raise sufficient revenue from taxation to pay the interest, that is, to service the debt, even if interest rates do not increase. If the interest costs on government debt do continue to increase in an effort to hold inflation, the debate over tax increases will have to be renewed, perhaps after a change in parties with a majority in the U.S. Congress and in the office of the President. It is likely that a political solution will impose new taxes on consumption rather than shifting the burden of taxation to unearned rents, as some of us argue is the necessary approach. An analysis by the Congressional Budget Office forecasts that over the next decade, more than 14% of all revenue the government is projected to collect will be sucked up by interest payments. This will be higher than total Medicaid spending, will be equal to half of Social Security benefits paid out, and nearly equal to total defense spending. A 2016 analysis of the U.S. economy by the International Monetary Fund urged U.S. lawmakers to take steps to generate a revenue surplus and gradually bring down the federal debt. The IMF economists wrote, "Near-term fiscal and monetary policies have been well calibrated to the prevailing economic circumstances, but demographic trends and rising interest rates will lead to larger fiscal imbalances over the medium term. This will cause the federal debt to begin rising in 2019 and exceed 80% of GDP by 2022. Regrettably, the U.S. continues to lack a detailed medium-term fiscal consolidation plan to prevent this renewed rise in the public debt. Of course, the IMF analysis turned out to be too conservative, as the level of debt is now well above GDP. The United States is in need of a real program of comprehensive tax reform, once and for all, finally beginning to collect unearned rents from the many natural assets generating rent. As for the federal government debt, one part of the solution would be to adopt fully amortizing bonds as the means of refunding maturing debt. These bonds would pay to bondholders both interest and principal, so that when the bond matures, the principal is fully repaid. Of course, far more revenue would need to be raised than is now being raised. Another worrying segment of the economy is the healthcare costs we are incurring. We will next look at the state of the nation's healthcare system.